welcome everyone to the first roundtable webinar of 2025. We're super excited to have you all here. A couple of housekeeping items. There is a chat. If you guys have any questions during the roundtable, please feel free to throw them in there. They will be answered as we go. And I will turn the time over to the LoanNEX CEO and co-founder, Eloise Schmitz.
Thanks, Brittany. Welcome everybody to our first 2025 roundtable panel. We're very excited to talk about maximizing volume in 2025. This year has already started off with a big bang. January was a really strong month, especially coming off of the holiday season. So this is a great time for us all to talk about what's coming up in 2025 and to hear from our panelists on what the market will bring and what we expect to see this year. First, let me introduce Lisa Schreiber. Lisa, thank you for joining us. She is SVP Correspondent Lending at eResi. She is a highly respected expert in non-QM and has been with eResi for almost a year now. We got the privilege of having you work with us for a couple of years, and now we have to share you. But thank you very much for rejoining us as a panelist on the roundtable.
Thanks. I'm really happy to be here working with you guys again and just talking about non-QM, which is a favorite topic of mine.
Yep. And John Wise, thank you for joining us. John is EVP National Sales with Newfi. John has had a long career in mortgage and certainly has been a leader in non-QM for most of his career. He joined Newfi about 2 years ago and has been an integral part of their strong growth. We've had the benefit of working together for really since I think 2018, and appreciate you joining us and giving us your insights into today's roundtable series.
Yeah, thanks for having me, Eloise and Raj and Lisa. It's always great to be with you, and always fun to talk about non-agency business.
Oh yeah. And last but not least, our very own Raj Parekh. He's SVP of Business Development with LoanNEX. He's been with us for almost 3 years. That's time really flies, and he certainly brings with him a lot of his expertise in building entrepreneurial businesses, especially in the non-agency space. So Raj, thank you also.
Thank you, Eloise, and thanks for joining us, Lisa and John. We're really excited to have you both on. I think we had like Eloise said, we had a really strong month. So interested to get your insight into what you think is going to happen for the rest of the year.
Well, with that, I'm going to repeat what Brittany said. If anybody has questions, throw them in the chat. We're going to be monitoring the chat and answering questions throughout the time. And this will be a pretty, open dialogue like we like to do. It's a little more of a fireside chat kind of approach. And we're going to talk about some of the current trends, some of the things we're seeing, not just specifically in the rate market, but also things that are going on that are affecting mortgage in general, and talk about our expectations and some tips for being successful in the mortgage industry. It's been a while since we've done one of these, so coming back and talking about some of these things that we haven't talked about in a while. But you can see, I'm assuming you all can see the slides up. I hope that those are up there. The left side is the MBA projections, and sort of left the 2021 numbers up there so that you can remember the great juxtaposition of what was going on when the rates were so low. But really, over the past year, the projections for rate decline have narrowed quite a bit, and as some of those rate reductions have been pushed off, and that slowed volume a little bit in 2024, but it was still obviously stronger than in 2023, and they're still projecting a 16% growth in 2025. What's interesting though is there is a fair amount of growth in refi activity and modest growth in purchase activity, and that's just because there's expecting to be some refi, in blips as rates are, going to move around a little bit. But love to hear, John, maybe I throw it to you first, your thoughts on the mix of 2025.
On the mix for projected 2025, yeah, I mean, it really is a great question. I think if you look at our portfolio, we don't think it's going to change too much. current pipeline's probably somewhere in a 40 to 45% purchase range, 40 to 45% cash out range, and then every once in a while we'll do a rate and refi for somebody that came in a couple years ago with those higher rates and has the ability to get something done. So, you know, we really don't anticipate things changing much, but it certainly is good to see the potential increases. I know, you know, as we were kind of all heading into 2024, you know, there was this kind of survive to 25 and everybody was hopeful and thinking about rates coming down and you know, in our opinion, rates are going to be higher for longer. So we don't think the structure is going to change. And by the way, I think we kind of need to get away from higher for longer. This is just what it is. Like, this is just the normal interest rate. Like, you know, you know, we were stuck on, and by the way, I think this is part of the story for 25. You know, you think about you know, potential homeowners, and they're sitting there hearing the same thing that we're hearing, which is, oh, rates are going to come down, rates are going to come down, the Fed's going to lower rates and rates are going to come down, and it's going to make it easier for me to qualify. And, you know, while I do think that rates will come down eventually, I think most homeowners now that the Fed has gone through 100 basis points of rate reduction and rates have not come down, I think most homeowners are in a position where they're saying this is what it's going to be. And I think that is really good and healthy for originators and mortgage companies, because it takes that person. Now the only question is, can you qualify? And can you get into that house? Is your payment too high? You know, can you get into that house? And because I think it's taken off that whole idea that rates are going to come way down. Because I was at an expo this was probably August, and we were doing a presentation. At the end of the presentation, I had one loan officer raise their hand up in the back row, and she said, "When is the refi tsunami coming?" And I said it already happened. And it's
You
not
missed
coming.
it.
It's not coming back again. You know, I mean, the economy is doing just fine, and we don't think the Fed's going to lower rates much anytime soon. So this is kind of the range we're in.
Yeah, and I would definitely say I agree with John wholeheartedly. I think that, you know, I was at the IMN for DSCR and RTLs, and then I was at the IMB, so talking to mortgage bankers in different spaces. But basically, I think everybody not only is saying, okay, I think we know that rates are where they are, right? And so we're just starting to what can we do in this rate environment? How can we qualify people? Where is the equity? A lot of equity, as you can see here, second liens. I'm sure we'll be talking about a few times in this presentation. Second liens, equity, you know, how can people tap into that if they're not moving? I do see our business is even more than 50% purchase still. We had a record year in 24. Non-QM, I think, is doing well, just because of, I think it's not as rate sensitive, as well as what we find is that people are looking for other opportunities for product. And so lots of that going on as well, which I'm sure we'll get into relative to the market right now.
Yeah, and I think oh, sorry.
No, I was just going to ask. I mean, there seems to be, if you look at what's happening in the middle of the country and even on the coast a little bit, home prices are stabilizing a little bit too. So borrowers are looking at this and saying, hey, this is our time to jump in. And in some cases, they're even kind of going down a little bit. Some home prices are going down. So maybe that would, you know, with the rates stable at where they are right now, and it seems like, I agree with you guys, it's not going to go anywhere. But even if home prices come down a little bit, it creates a buyer's market again, you know. So that's, I see purchase being north of 50% for both of you through the course of the year.
Yeah, Raj, and to that point, one of the data points that we use is average days on market. There's a lot of different sources for this, but there's some Redfin data in the kind of all metro areas of the United States, and we're seeing days on market rise. And I view that, I wouldn't normally view this as a sign of hope, but today I view it as a sign of hope, because I think that will take off some of the pressure that we're seeing in these kind of massive increases in home values. that's a really good sign.
Well, another thing that's been interesting to watch is the evolution of second lien products. And we're going to keep talking about that as we go through this. But it's hard to get, good numbers because so many of those are held on portfolio. But the amount of liquidity for both HELOCs and closed-end seconds that has, it's supporting just a large amount of new entrants into that part of the market, which is just making it even easier for people to access them. The hard part is making sure that people know where to access them and how to access them and work through them. And that's, getting into a little bit of a LoanNEX advertisement, but still there's a lot that's changing on that front. And I don't know if you guys want to comment quickly on, what you're seeing on the second side, but that's been a big change over the past year.
Yeah, I would say for sure, as you say, the equity's there, right? So seconds are not only a bank product now, as you say, the private equity firms, the insurance companies, I mean, everybody sees value in the second trust market. We do, I'm sure John probably does as well. So it's a majority of the large investors that you see in the non-agency space either will or are currently offering second trust products. And I do think we'll see those. I know certainly for us at eResi, we are definitely going to be looking at them a lot more strongly. How can we present a product that will really help the market and that our lenders can utilize? One of the challenges of a second lien for loan originators is, and especially loan officers, is how do they make money selling a second lien product? So a lot of nuances there around whether you use a full appraisal, AVM. So there's a lot of ways to look at that product, to make that product really accessible to the loan officers so they can make it accessible to their borrowers. But I think we're all working on that right now.
Yeah, no, I would agree with Lisa. There's obviously a lot of reasons for this. From a demand side, I think the last report was a $13-14 trillion of equity in the U.S. housing market. You've got borrowers, kind of U.S. debt to income is somewhere around 11 or 12%. And then when you combine that with an increase in revolving and installment debt to an all-time high of about $1 trillion to $1.2 trillion, there's certainly going to be demand for borrowers to tap into that equity. And then obviously you combine that with a lock-in effect, and it makes it a really good time for borrowers to tap equity. But then when you kind of go to the supply side, Lisa's exactly right. The value of these loans is very, very high. So you have banks, you have credit unions, you have people like Apollo Athene and Newfi and eResi offering products. So there's plenty of supply. And so then the question is exactly what Lisa's talking about. The big question is, can loan officers make money originating these loans? Because historically, there just has been a very, very thin margin. There's smaller loan amounts. Most loan officers aren't really interested, and it's tough to make money. You gotta. So there's all sorts of ways now for loan officers to originate these loans. And it's one of the great things about LoanNEX is you guys have done a really good job of putting these closed-end seconds into your system, so that the loan officer can go in there and identify whether or not there's a transaction or not that might work for their borrower easily and quickly. And most of what we're seeing on our end is, so our bank statement second lien product is, I think the average loan amount is about $350,000. With in a lot of places that's a nice average loan amount. So you can definitely figure out ways to make money as an originator. But what we say, and this is like a whole non-agency theme, like you can extend this out to everything, is if you create value for your borrower in that transaction, regardless of how much money you make, they are now a referral source. And that is the most important thing in the mortgage business. It's obviously, it's an obvious statement, I know, but people forget that all of these borrowers that people you refinanced back in the day into a 2.5-3% mortgage, they're a prime target for you for creating a second lien and creating value for those customers. So we think it's a really good time.
And John,
Yeah.
I wanted to ask on the second lien, do you see a trend where people are pulling out equity from their homes to buy investment properties? I mean, there's a twofer there, right? I mean, they're pulling out their equity, they're buying an investment property, a short-term rental or something like that, and increasing their real estate portfolio. So it does lend way to two transactions there, for
Yeah.
for the loan officer.
Absolutely. No, absolutely. I mean, the last thing you want to do right now is take your money out of the stock market. I mean,
Yeah.
people are trying to figure out ways to use the leverage that they have. And this is certainly one of them, whether or not it's to pay off debt and improve their situation or go buy a new investment property, which is certainly an opportunity for the loan officer to create more value and current income on that transaction.
So I'm going to switch gears a little bit, not very much, but switch gears a little bit because the slide I have up, we've been tracking some pretty, I think they're very important trends that are changing a lot of the liquidity, changing the demand, changing sort of a whole rotation that's going on in the mortgage industry that I think is important for, people to understand. And this, under the theme of you have to have more products in your toolbox than just agency to really make it work in 2025, 2026 and on, because the market is changing. And just real high level, the slide talks about a lot of those, but there is a change in liquidity sources. So even from banks' perspective, what banks used to hold on their balance sheet, they're really not holding anymore. So that means those loan officers or those borrowers have to find a different source than they used to have. And that's a very common theme. I don't know if you guys are seeing it as a change in your demand, but there's just less that's being held on bank balance sheets, more that's moving into insurance companies and institutional balance sheets. But that's a rotation that's causing different products and different programs that you have to, be geared up for. So I'm just going to hit some of these and you guys can talk about them as, after I just hit real high levels, but that is a pretty big change of liquidity sources. There's also, the borrower demographics that have been continuing to change really since COVID. Those are what we're seeing now is what you guys were just talking about. There's getting to be a little bit more of an acceptance of rates. So that acceptance of rates is starting to loosen up those first-time home buyers where they were really reluctant to jump in. And I think some of them are we're seeing at least a little bit of acceptance there. John, I saw you, sort of look up. I don't know if you agree with that, but it seems like this is less startling, and maybe that's a hope and not a fact, but it seems that way.
No, absolutely. By the way, Eloise, I'm going to steal this slide. I love this slide. I think it is an amazing presentation of what's going on. As soon as I saw it, I'm like, I love this slide. It really does tell the story. If you think about non-agency, these borrowers have always existed. It's not a matter of whether or not the borrowers existed or not. They've always been here. But we are seeing more of them, more people buying investment property. Why? Because of the lock-in effect, because rental rates have gone up, because values have gone up, because people want to invest in U.S. real estate. Those borrowers, definitely you're seeing an increase. Self-employed borrowers, you look at COVID and the increase that we saw in business formation right after COVID. And we think that's going to continue. If you think about the Trump administration and their deregulatory environment, we think more businesses are going to get created. So we think it's a really good time. So that's kind of the borrower. The borrower's always been there. But then, the biggest change that we've seen in non-agency over the last 10 years has been the liquidity source. That has certainly changed. And I think if you think about non-QM as a business on its own, we're past proof of concept. Like we've established proof of concept. We know how these loans are going to perform. And we know that they perform at about the same rate that agency loans perform, better than FHA. And so as a result of that, you have institutional money that's come into the space. and really change the dynamic of the market. And because, you know, if you go back even probably 4 years ago, probably kind of pre-COVID, the only source for liquidity was a securitization. And
Yeah.
and that has now changed. And as a result of that, you now have at least two sources of liquidity, maybe more, but you have a securitization model that's working really well. Credit spreads are super thin, so it means it's a good time to securitize product. All product, by the way, asset-based, you know, it doesn't matter what's a non-QM loan or any asset-based product is a good time to securitize. But the second source is balance sheet. It's just not bank balance sheet. It's insurance companies. You know, Newfi's owned 86% of the company is owned by Apollo Global Management. They merged with a company called Athene, and Athene is an insurance-based annuity company. And most of the loans that we originate go on the insurance company balance sheet.
Right.
And you know, we don't think that model is going to change. And now that we're through proof of concept, we think that will exist in this market. We think it'll exist in 5 years, because you're still talking about a loan that's attached to the U.S. real estate markets and the U.S. economy that we think is really strong. So we don't think the model is going to change moving forward.
Yeah, and I would just tap into, apologize, Raj. I would just tap into a couple of things that John said. One definitely is the borrower demographics. I was talking with somebody recently, and we were just talking about the type of borrowers that are now more the norm. If you think about TikTok and all these places where people are, you know, have like, you know, side hustles, basically, right? I mean, like I might be, you know, somebody that works full time somewhere during the day, and at night, you know, I have a whole nother business online, or, you know, I'm an Uber. Every time I get in an Uber or a Lyft, those are all people that have this, what we call the gig economy now. So, and if you think about how a typical Fannie Mae, Freddie Mac loan is originated, you know, you need your 2 years of W-2s and all this, you know, part-time income. You know, can't count it here, can't count it there. They just don't fit. They don't fit the traditional models anymore. The traditional models need to change. And where is that changing? It's really changing in this non-agency space. So I would even say that the products themselves, as utilized and as you can really put together a picture of a borrower and really recognize all of the ways that they make money today, is generally in the non-agency space. And so it's just a space that gives your borrowers the opportunity to get a mortgage that, you know, just it would be challenging to document otherwise. So the products themselves, I think, are becoming more normalized. People understand them better. Bank statement product, for example, I say it all the time. You know, bank statement analysis, there's amazing tools out there right now to utilize. Oculus, Prudent AI, there's great tools. And as soon as you get that income analysis, the rest of the loan is exactly the same as any other loan that you would do. DSCR, you're really just looking at cash flow for that investment property. So I do see more and more people utilizing the products on a consistent basis, getting comfortable with them. They're not fearing it. And then just again, on that changing liquidity sources, you know, it's great that we have all this additional money coming in. You know, we have the ability to do, you know, portfolio investor, institutional investors, or we can do securitization. So even we even have the flexibility now within my organization and others to do that. So it just, if you don't really understand the products, or if you don't really get it, LoanNEX, as we all know, is a great tool to help you figure it out, but it's there for the taking, and people are doing very, very well with it.
Yeah, I wanted to add to something John said, and what I'm seeing on the institutional investor end, the appetite from these institutional investors is bigger than I've ever seen before. They're wanting more volume. So there's an opportunity there for, and I see credit boxes expanding a little bit too. So they're making it easier for borrowers to fit into these programs. So it's an interesting beginning of the year. But what I'm hearing out there more than not from all of these institutional investors and the companies that represent them, that sit on the front end, like Newfi does for Apollo and Athene, is we want more volume. We want more volume coming in. So it's an interesting time.
Absolutely.
That's the
Yeah,
thing about
and
institutional money, Raj, is they're like, as soon as you get access to it, there's never enough, right? We can never produce enough loans. So
well,
Yeah.
and
it's a good situation.
this is an interesting way to look at it as well. And this is going back a year. And if you look where we were in January of last year from a rate perspective, but also more importantly, a spread perspective. And so the black line on this is just agency rates, 30-year agency. And then the gold is a LoanNEX index of all of our all of the investors that are on our platform, sort of averaging out for the same loan profile. But that's representing 65% loan to value and a 740 FICO. And then we've got the silver that is down at a 680 FICO and I think a 70% loan to value. So you're seeing a little bit of that box widening, but what's also important is the green line is the DSCR. So what we've seen over the year, about middle of the year, the DSCR and the gold pricing converged and has not, delinked since. And that has everything to do with investor appetite. So that is demand. They are happy with that paper. They want that paper, and it has reduced the price or narrowed the spread right on top of that gold pricing. And we've also seen gold and DSCR pricing tighten to the agency loans. And we're seeing that it tightened quite a bit in late January. And it's still, but it's under it's under 50 basis points. And it had always been tracking right around 75 basis points. It went from a little over a point to 75, and now we're under 50 basis points. So I don't know how long that's going to stay, but that shows the appetite of the investment community and the strength of liquidity coming into this part of the market to help that pricing come down. But we're still seeing some widening as you go out the credit box. It's still gonna price up. But I don't know if you all have other comments on what's going on, but that to me is very telling on where liquidity is, where the interest is, and certainly some of those pops will show where the refi activity goes on. But
yeah, but some of the non-QM to agency tightening also has to do with the pressure on higher on rates, 10-year treasury versus I think most of what we look at from a pricing perspective is shorter term treasury. So on the non-QM side, we're probably more focused on a 5-year treasury than we are the 10-year. So the fact that the shorter term treasuries have come down is helping to shrink this margin, continue to shrink this margin over time.
So I'm going to put
go ahead.
I was going to say, I'm just going to put a plug in too. Everybody needs to understand these are not that wide from agency. So when you're talking to a borrower, this is just about getting them into the best product for them that's going to match what their needs are. And the pricing is really not a driver. It's pretty tight to the agency pricing. Sorry, Lisa.
Yeah. Yeah, no, and I was just going to say, and when you think about what we talked about earlier, qualifying your borrowers, utilizing the income that they actually are recognizing, right? Whether it's a gig, side gig or whatever, documenting that, really, doing that in a way that makes sense, but then also doesn't put a lot of burden on your borrower. There's real opportunity here. I know on the non-owner occupied agency product, which we do offer, right around 80% LTV, we actually are priced better than agency,
right?
Because agency has all these, very heavy LLPAs associated with it. So really, even looking at opportunities like that, people really should be aware of.
Right, exactly.
Yeah, Eloise, when you think about kind of the proof of concept idea for non-QM, when we first started doing this, it was 300 basis points spread between, and now we're talking about 30 basis points.
I know we spend a lot of time on these webinars
crazy.
trying to teach people how to talk about rate and how to talk through it. And, this is a lot of why we started LoanNEX was was this is where it should be. The market should be able to price that risk and then be able to distribute it out so that a loan officer can consume it and sell it to a borrower.
Yep.
And I'm love where the market is. I'm super excited about where things are going, and this is where it should be. That this is a very strong, well-funded industry, and it is showing in the innovation of the products. It's showing in the depth of the products, and certainly in the spreads to the agency products. I'm going to switch to get some stats, because this is where it gets, you guys can talk a little bit more about your actual products, and we're going to talk a little bit about what we're seeing in a little more granular basis. But we saw January pop. We had almost 50,000 scenarios. November and December had sort of odd holidays, the way they fell. So there was a lot of almost, lost a week pretty much out of each month. But January came in strong, stronger than, usual. But we also saw some pretty unusual trends that we haven't had enough time to really dig into. But we saw average loan amount pop quite a bit, and we saw a lot of activity on the refi side, and frankly on a lot of the rate term, because we saw that rate, the rates had a quick blip down and then come back up again. So that was pounced on pretty quickly with some refi activity. But we're also seeing it was also hit in the full doc side. So we saw some unusual shifts in the mix. I don't know if you all saw some of the same things, but there were some pretty unusual changes in January. Not sure it's a trend or if it was just the month, but curious what you guys saw.
Yeah, we definitely saw very similar things. We definitely saw the blips, and we do think that, given some of the uncertainty that's going on right now, we may still see, kind of like interesting daily totals, right? Some days are better than others. But yeah, January was very strong. It was a nice January, because as anybody who's been in the business a long time, that's not typically true. I would also say that full doc, we see full doc a lot when people are looking for a jumbo loan, but they, for whatever reason, they utilize our full doc. Sometimes we're priced better. Sometimes it's more documentation related. So we actually, for those accounts that we talk to that aren't, maybe they're a bank statement, they don't do DSR, we talk about our full doc a lot. And so we definitely have seen some improvement in or increase in that volume as well. I think on the purchase, we've always been strong. And the refis, I think, like you said, I think people are just like watching to see, it's like, what's today gonna bring? Let's hit it, but we're definitely seeing very much the same thing here.
I mean, the one thing that we've proven as an industry is we know how to refi.
Yeah.
So,
we sure do.
So the minute that it becomes able to refi, you're gonna refi and lower that payment. So we've certainly proven that. I actually think that if you broke this chart down in half months, you would see a big spike first half of January to the second half of January. That's certainly what we saw on our end. I was a little bit surprised by it. We actually thought we would maintain momentum into January. I had this thought in my head that 2024 hadn't been a great year for loan officers, so we thought maybe they'd continue to work through the holidays. But somebody gave me another perspective a couple of weeks ago. I was in Connecticut, and I was sharing this idea with somebody, and he said, I think the exact opposite. I think loan officers are so tired from how much work and how much grind they put in 2024 that they just needed to take a couple of weeks off. And so that's why I think you saw that that slowdown, typical slowdown, Thanksgiving to kind of through the holidays. But what we're finding on our end is our app volume is back at kind of a higher level. Not much change in the product in the purchase refi, cash out refi. Not much change there. But we did see a big rebound in our bank statement product. So we think that we did see a rebound in DSCR, but not as much, not as high a pace. The bank statement product definitely has taken off over the last 2 or 3 weeks.
That's good to hear. I mean, this is breaking it down a little bit more, purchase versus refi. And I like your idea, John, if we did divide it out in the first half of the month and the second half, but don't have that here. But that jumbo activity that's driving the FOLDOC on purchase, I mean, that you can see pretty distinctly. It's changing the mix. I would say disproportionately. It hit bank statements a little bit more than it hit DSCR. That sort of hit proportionately with the increase in that jumbo FOLDOC volume. But over on the refi side, it was really the story of DSCR for refis and a little bit of an increase in FOLDOC, but it was really continued to be in that investment property sector that refi activity was going on. So I was, a little bit surprised. I thought that might have been a little bit more, a lot of the traditional rate term refi, but just disproportionately or proportionately, that growth still hung in the DSCR segment.
But it's,
Yeah.
I would say it's primarily in the refi kind of cash out where these guys are buying
Mhm.
multiple investment properties, right? So
For
they're
sure.
pulling their money out to do that. I mean, 42% refi is nothing to laugh at. I mean, that's pretty good. I wouldn't have thought that, that 42% of the business, I thought that it would be very heavily weighted purchase, but 42% is impressive, I think, for, that just goes to show you that people know that the rates are stable now, and this is what it's going to be. It's sinking in. Maybe 2024 was like we said earlier, 2024, everybody was like on the fence about stuff sometimes. And maybe this year, now that it's sunk in, people are just going to start transacting, buying the homes that they want, taking the money out that they need to buy other properties. And it's just going to fuel that business, I think.
I'm surprised that the bank statement is so low, though. I mean, we do an enormous amount of bank statement production, and John just mentioned that his is on the rise. So I'm surprised about the bank statement percentage.
Being on the refi side or on the purchase side?
Both.
Probably
Both?
either. Yeah.
Yeah,
Yeah.
both.
I would
I
say
mean,
both.
I
Yeah.
think what's interesting though, and these are volumes of loans getting priced. Not all of these are locks, right? So this is a little bit of a leading indicator. But what I find too is we have so much, like I was showing up here, about 55% of all of the loans coming through the LoanNEX platform are investment property, where your volume is not 55% investment property. But the
Mhm.
reason why is those are some of the hardest loans to price in a traditional pricing engine. So we do get a skew of volume, especially around those loans that are harder to navigate. So I was actually surprised to see as much FOLDOC pop in our data as we did, but I'm not surprised that you're having a higher percentage of FOLDOC than LoanNEX sees, because LoanNEX is really driving answers for those that are more complicated and those that are outside of what your traditional pricing engine can really support. And this is a little bit of a plug for those that don't know LoanNEX very well. We make it really easy to navigate these different income types, but we also then ask questions that are specific to each investor and specific to each program, so that you will know exactly what you need to know, whether it's an investment property, a bank statement deal, DSCR, whatever that profile may be. We're able to direct you to through all those soft guideline eligibility and pricing criteria. So that's why we do see a little bit of a higher volume in some of those areas.
That makes
That's a
sense.
good way to
Yeah.
put it. I mean, people do use LoanNEX as kind of this sandbox environment, and where they could come in and discover. You don't. I don't want to plug LoanNEX too much, but the soft guidelines things is really important for originators that don't do that much non-QM. We make it really easy for them to kind of understand whether the borrower is going to fit into a certain program without having to go through pages of guidelines and pages of matrices. We just put it out there so they can easily price it in there. So yes, our results are going to be skewed a little bit because originators are coming in and sandboxing a lot in our platform.
Yeah.
And this is the investment property trends, spiking those out. So we saw a little bit of a decline in purchase, I should say, an increase in that refi because of the blip in the rates. You know, they are going to jump on that as quickly as they can, but you can see how that shifted. But we're pricing $15 billion of investment property loans. Those are unique loans in January alone. So this is a very robust part of the market. Obviously, that means we're still pricing about $15 billion of non-investment property loans as well. But it is a very robust part of the market. In watching the trends is really more, like I said, a little bit of a leading indicator because this is where all that sandboxing is going through. But I don't know if you guys have other things you want to talk about on the investment property side that that you're seeing as well.
The only thing,
Yeah, go ahead, John.
oh, sorry, Lisa, go ahead.
Yeah, I was going to say, I think the investment property products are generally holding steady. I think obviously they're well utilized. I think for those originators that really understand the product, understand the borrower, understand where to find those borrowers, I think they're locked in. You know, I find, and I'm sure John does as well, that whenever I look at a particular seller, we are correspondent only at eResi, so we deal with non-del and delegated sellers. Whenever I talk to a seller, I always say, you know, do you have groups, specific groups that are targeting these borrowers, or are really experts in these borrowers, or groups within your teams that people can access? And that's what I find the most successful people are when they utilize the programs. But I think those people are locked and loaded. I think they're pretty well established at this point. When you think, John?
No, for sure. I mean, look, I mean, this is the demand here is really relational to rents. So if you look at, you know, if you look at rental rates, they're still on the rise. They're not they're not rising as fast as they did, say 12 months ago, 18 months ago, where it really peaked. But we think if values stabilize or continue to increase, you're going to see rents continue to go up. And so the demand for investment property is still off the charts, and we don't think that's going to change. I mean, some of this is the lock-in effect. Some of this is the you know, people wanting to continue to invest in U.S. housing, but not walk away from their primary, so they're buying investment properties. And you're seeing, you know, I think from our standpoint, the pressure that we see here is really going to come from no ratio DSCR. At Newfi, we cap, we have a limit of 0.8. So you're starting to see a little bit of a rise in delinquencies under 0.8. There's kind of no ratio DSCR. You're starting to see some delinquencies rise there, but the loans that are cash flow positive are all performing really well, and so you're going to continue to have product and supply coming from people like eResi and Newfi.
So just doing a little bit of a time check, we're at 11:45. And I want to take a second to talk about just how important having access to these programs is to your success in 2025. I mean, that's the root of what we've been covering this entire webinar. Is if your LOs have access to these programs, they can serve more borrowers. Obviously, we believe if they have tools to make navigating those programs easier, they're going to be able to really be able to serve more borrowers. But this is really about partnering. So want to encourage everybody to partner with your investors and your lenders to have access to more products, to understand them, to lean on them in structuring, to work through whatever your loans are. I know that Newfi and eResi spend a lot of time making sure that they are having the right tools and processes in place to make as many loans successful as possible. And I encourage everybody to get your own path to yes. Create your own non-QM specialist in-house, or a channel for it. Anything that will make people less intimidated and be able to work through this really easily. I don't know, you know, Lisa, we've gotten a chance to work with you for a long time. What are some of the advice that you give people on how to create a good platform for helping people that are coming into this part of the market, you know, succeed?
I certainly think, somebody asked me even not long ago, do I have equity in LoanNEX or something? Because I talk about you guys so much. And I said, no, I do not, but maybe I should talk to Eloise about that. But truly, I just think that, and actually I've been in the non-QM space for 10 years now, which seems so strange to me that it's actually been 10 years. And I spent the last few years before joining eResi full time as a consultant helping people put together their platform. So to me, it's education, education, education. It's support, support, support. So making sure that you really do understand the product, understand the borrower, understand how to apply the programs, which of course LoanNEX helps dramatically. It leads you through to the opportunity and the type of programs that are available. But then I would say for your loan officers, if you're putting together a platform, you have to also have the ability to give them support. They're going to have a lot of questions. There's a lot of exceptions in these two products. We're probably about 35% exception based, which means that we have an excellent scenario desk that works with our sellers to understand how to utilize the product. Can they push here, there? This loan makes sense, but it has a weird nuance here. How is that going to apply? So supporting your loan officers, educating your loan officers, certainly partnering with great companies like eResi and Newfi, because they will help you with those things. That we provide that support to you. We help you build those programs. So those are all the things that I tell people right out of the gate.
Hey, I have a quick question, John, because you're at Originator Connect right now,
Mhm.
and I know both of you, and eResi has a wholesale arm as well. But do you see a trend? Do you see a change in the trend of brokers that are coming on? I know in the beginning of 2024, even somewhere in the middle, we were talking about like only 10 or 12% of brokers are doing non-QM. Are you seeing an increase there? And then also on top of that, if you're seeing an increase there, are you seeing more brokers going to mini core or non-del and kind of evolving there, and those non-del guys, getting into delegated relationships? Is there a trend that's moving that way?
Oh, it's a great question, Raj. Yeah. So we have wholesale delivery, we have non-del and del delivery channels. So we get an opportunity to work with all different types of customers, and we are certainly. I don't know that this is just a Newfi thing. I mean, I have to go back and look at stats, but we doubled the number of loan officers we closed loans for from 2023 to 2024. Some of that is just Newfi growth, but I think a lot of it is originators saying yes.
Yes.
I'll use non-QM. So it is a mind shift, and we talked a lot about that. So that's kind of one piece as it relates to companies going from broker to non-del. Absolutely, you're seeing that, and that speaks to it speaks to the space that we're in, and it's, you have all, like, you go back to that chart, all these different liquidity sources. If you're an originator today and you're doing your agency business in house, I guarantee you somebody's calling on you to sell you non-QM products on the correspondent channel. That's definitely happening, and
Right.
and people are walking into that because they feel comfortable.
Exactly. I think your education is working, is the point that I was trying to make. All this time
Yeah,
that you guys have spent over the last couple
yeah,
of years
yeah,
really educating the market is turning,
yeah.
when you see somebody move from wholesale to non-del, it means that they're comfortable doing these loans. They have confidence. They have teams that are confident, so
That's right.
interesting
Yeah.
trend.
Yeah, no, for sure. And the other thing that I would say is, if you think about that correspondent investor, they don't want to take risks that loan's not going to get bought by somebody, and now they can take it. But the other thing that's really kind of mind shift, and I think a difference in the business today is, if you think about the correspondent space, kind of, you go back to history, like not even pre-COVID, but this has just been a typical mantra from a correspondent lender. Once you go core, the correspondent message was always, "Hey, stop now! Stop talking to my loan officers. I don't, as a correspondent investor, like I appreciate you buying my loans, but don't talk to my loan officers anymore. That used to be the mantra. Like you used to have, like, as soon as you went core, there was a separation, and they did not want you communicating with their loan officers. Today, if you look at what we're doing at Newfi, a lot of what we're doing is nuanced. And so when you're in direct communication with our underwriters or the chief credit officer, you're able to figure out ways to get deals done. Well, if you're
Right.
one of those correspondents that says, don't talk to my loan officers and we'll do all of this on our own over here on the side, you lose a lot of that deal making capability because you're one step removed from the source. And so we find today a lot of the people that we're doing business with, they want still direct access. Matter of fact, we just signed up a big correspondent seller, and they actually said to us, "Would you be willing to go to one of our offices, one of our bigger offices, and talk to our loan officers?" And this is a big company. I mean, they're not new to it, and they wanted us to go and have direct interaction. That is definitely a change to the business today. That we think is a good, healthy change because it gets you closer to that source of figuring out ways to say yes to more borrowers.
I love all that. And it's and we're finding it too. That's why we're seeing so much more traction on the platform as well, as people are trying to find ways to make it as intuitive, as unintimidating, and as easy to, say yes to more loans. I so appreciate you guys being on this call and offering all of your insights. I want to give you a chance to let people know a little bit more about your programs and what you're doing. We've got just a few minutes left, but Lisa, you want to talk a little bit about eResi?
Sure, I'd love to. So eResi, a lot of people may not have heard of, but we have been in business since 2019. And as I said, it's really the team. I joined them in March, but I had been consulting with them for a couple of years previous to that. It's been a small company that we've grown. It's still very tight knit. So we're super proud of every one of our people. We've got a long-term capital base. As John said, we've got a big insurance fund behind us. And we also have our own shelf if we wanted to do securitization. So we are a very strong capital partner for liquidity. We have a full product suite. Pricing, I would say for us, we have a box that is not crazy credit wise. Like we don't necessarily go like high LTVs, and we just don't go low FICOs, but what we do very well, and we price very well. So that's a lot of how people know us. And the other thing is our credit team, our scenario desk, our exception desk. We actually are known for more of a common sense approach and are very, very good at returning those answers quickly and definitely help you structure the deals. We will buy loans. It's not mentioned here. From a correspondent perspective, we will buy loans on seller reliance. We will buy loans, through bulk trades. We also do flow all day long and is the primary source of our correspondent business in both non-del and delegated. Our products, as we talked about already, include the full doc. We do have, of course, all the alt doc with the bank statement 1099, P&L, and VOEs. We do with the investor programs. Seconds, you'll see a lot more about us in seconds, and then the eligible non-owner occupied is discussed. So thank you for letting us be on this. And we are in LoanNEX, and you can lock
I was going
with
to
us
say,
through the
yes.
LoanNEX process. So it's a great experience. You're in there, you can lock directly through the platform.
I was going to say that is a really unique workflow. So LoanNEX not only supports all your programs and delivers them out to many of your correspondent sellers, but their lock desks can lock directly from LoanNEX into eResi. So just a very streamlined approach. And I see a hand raised, but I don't know what I can do with that. So if you can just
I'll
type
take
your
care of it,
question
Eloise.
in.
Give John his 5 minutes
Yeah.
on his.
Perfect. Okay. All right, John, thank you.
Oh, thank you. Yeah, Eloise, thank you so much for the time today. I always love talking about the business and how brokers or IMBs or banks, credit unions can make more money in this environment. it's a challenging time to originate loans. And I think, you know, what we're doing here at Newfi is just trying to figure out ways to say yes to more borrowers. We've already kind of talked about our multiple channels, wholesale. I know you guys do business with a lot of brokers, but we've got a full suite of non-QM products that can get delivered wholesale, non-del, or a delegated correspondent. This is non-QM. It's second lien products, and you know, we believe if you're looking for a good, reliable non-securitization outlet, that we think we are one of the most reliable and stable takeout sources in the industry, and we're excited about 2025. We love our partnership with LoanNEX and the benefits that you provide, and like I said, we're just trying to figure out ways to say yes to more borrowers. So thank you both and Lisa, it's always good to be with you.
Well, you guys have been amazing partners. We've worked together for a long time, and we are going to distribute this deck. It's going to be available right after we wrap up the webinar. It also has links, so it'll have all contacts for everybody. You can get in touch with anyone from LoanNEX, Newfi, or eResi directly through these links. And I just want to say thank you again for being such great partners and for joining me today. This really is a super exciting time. There's so much rotation going on in the market. I can't encourage originators enough to make sure you've got these tools. LoanNEX is available. There's a free solution and there is a paid solution. We can be inside your technology stack or on the side to augment what your workflows are. But either way, it makes it really easy to make your loan officer successful. So reach out and talk to us. We're happy to help in whatever way we can. So excited to see this growth and what's going on in the market. 2025 is going to be a great year. So really appreciate it. Thank you, guys.
Thanks very much.
Thank
Thanks,
you.
guys.